Welcome everyone to the Ag Economic Dialogue session. We're glad you are able to join us today. I'm Heather Gessner, the Livestock Business Management Field Specialist for SDSU Extension. Glad to have you here with us. We do have two presenters for you today, so I'm not going to take very much of the time right here this morning, other than to let you know that we'll take questions during the presentations, or if you want to wait until the end, we will turn the recording off and take questions at the end so that you don't have to worry about your question being recorded. So otherwise, type them in the chat. Feel free to raise your hand or something, and we will try to get your questions answered for you. So with that, Sarah, I'm going to turn it over to you, and you can do your own introduction there, and we will be off.
Sounds great. I'm going to go ahead and share my screen. So my name is Sarah Sellars. I'm a new assistant professor and extension specialist in sustainable farm and food systems in the Ness School of Management and Economics. So I'm new here. I just started in August of this year. Really excited and honored to be here talking with you a little bit about Farm Bill 2023 with a focus on conservation funding and South Dakota. So I'm originally from Illinois. I grew up on a grain and livestock farm there, and that's kind of where my interest in agriculture got started. Some of my previous work has focused on looking at adoption of conservation practices like cover crops and nutrient management, and how we can think about doing those in a profitable way. So mostly I've been working with Illinois data, but now I'm here in South Dakota. I'm trying to shift my focus, think more about the South Dakota data, think more about the South Dakota agriculture, and I'm learning a lot and really excited about this opportunity. So some of my previous work, I've been working on some projects looking at conservation funding, particularly as a sustainable farm and food specialist. I want to think about conservation opportunities and how we can position farmers in South Dakota to benefit from these practices and these opportunities that are presented for practices we know a lot of our farmers are already doing. So, but then I also wanted to make it a little more general and talk about Farm Bill in general too, because that's been a really hot topic. So I'm no expert on the Farm Bill yet, but I'm really thankful we got a lot of experts here on the call. We've got Heather and Jack and Triwit and Matt. So if there's a question, I might have to ask them to help me out if I don't know the answer. But so I'm going to talk a little bit about some of the news that's been going on related to the Farm Bill. I'm going to talk about the Congressional Budget Office projected spending. Where has spending been historically? And then I'm going to talk about the increasing focus on spending outside the Farm Bill. So as you've probably seen in the news headlines, the replacing the House Speaker has been a really big topic of discussion. So Farm Bill has kind of taken a backseat to first replacing the House Speaker, because without a House Speaker, we cannot proceed with any new legislation, which includes the Farm Bill. So until that all gets worked out, we can't even begin to think about the Farm Bill. So I don't have any good intuition about when that will all get resolved, but there's been a lot of focus on it, especially in the agriculture news, and how the outcome of the House Speaker replacement could affect Farm Bill timing and what's contained in the Farm Bill. So the most recent Farm Bill, the 2018 Farm Bill, expired. So now we're waiting for some sort of stopgap measure or some legislation to pass that would need to pass by the end of the year. If it doesn't, we could see disruptions in some of the programs. So the programs which are funded by appropriations, like the Supplemental Nutrition Assistance Program and crop insurance, those wouldn't be affected. But other programs are only authorized until the end of the year, like some of the commodity programs, some of the dairy programs. So if we get to the end of the year without any farm bill legislation or stopgap measures, then this could be a big problem for some of those programs. There have been some people suggest that this will get done by the end of the year, but as with government and policy, we never know. So one of the big headlines in my AgriPulse newsletter I received yesterday was Senator Grassley from Iowa suggesting that it will get done by the end of the year. So we'll see what happens. And funding priorities for the new farm bill. There's been a lot of discussion, as always, about commodity programs versus SNAP, and also conservation funding and how that kind of fits into the picture. So now I want to talk a little bit about the future budget projections from the Congressional Budget Office. This is the projected baseline spending through 2033 for the Farm Bill. So the Congressional Budget Office updates this regularly, and this is merely just an expectation. This is not set in stone, but this shows you kind of how Farm Bill spending is divided up and kind of a projection for what's going to take place in the future. So in our Title I, we have our commodities programs. So these are things like ARC and PLC, price loss coverage and agricultural risk coverage. These are some commodity programs offered through the federal government. We have our Title II, our conservation funding. So this is the money for CRP, CSP, EQIP, these types of environmental programs. We have our crop insurance title, so which is very important for both crop and livestock producers in all regions of the U.S. And then we have the Supplemental Nutrition Assistance Program, or SNAP, which is the largest percentage of spending in the Farm Bill. And so we note that the total billions of dollars allocated in the budget for the Farm Bill has to be divided up between these different commodity titles. So for that reason, there's always, when it comes to Farm Bill, there's always a lot of fighting between the titles, because if you want to increase funding for one title, that funding has to come from one of the other titles. So next, I want to talk specifically about conservation spending. These are the projections for future conservation spending through 2033. So we can see the three kind of main parts of that budget are CRP and technical assistance for CRP programs, CSP, and that's kind of divided out by 2014 and 2018 because of kind of how the data appears in the reporting, but that's all CSP, the gray and the orange, and then the EQIP program. And then we have some other kind of smaller programs like ASIP, RCPP, and then we have some other programs like some wetlands reserve programs. So we can see kind of a projected increase in conservation spending through 2033. So now I want to get a little bit into historical spending. So what have we seen over the last Farm Bill, especially in South Dakota? So this is a really nice recently released tool by Professor Jonathan Koppas at University of Illinois. It's called the Policy Design Lab. So it's a really nice data visualization of all Farm Bill data from 2018 to 2022 by state. So when we look at this, we can see the total funding in billions of dollars for the 2018 to 2022 Farm Bill. And then we can see which states are receiving the most total Farm Bill benefits. So we see South Dakota is on the kind of the lower end of the total Farm Bill benefits. The lower end of that scale starts at $526 million and goes all the way to $49 billion. And the two states receiving the most benefits are Texas and California. But remember, this map is not just the agricultural Farm Bill spending. This also includes spending for Supplemental Nutrition Assistance Program, plus all the traditional agricultural spending we would think of, like commodities, conservation, and crop insurance. Now I want to kind of think about how conservation funding has been divided up by state, and then focus specifically on South Dakota. So when we look at conservation spending, we see that South Dakota is in the $1 billion to $2 billion range from 2018 to 2022. We see most of the conservation spending, of the total conservation program money allocated, Iowa is receiving the most. And then we kind of have South Dakota, Minnesota, Illinois, and Texas. So this just shows how important some of these programs are in South Dakota and for some of our South Dakota producers and ranchers. And so what programs are people in South Dakota using? I just want to show a little bit of data about that. So most of the millions of dollars in funding in South Dakota for conservation are going to CRP or CSP programs. And then we do have some acres enrolled in EQIP, ASIP, and the Wetlands Reserve Program, WRP. But we can see specifically two of the most important programs are CRP and CSP in this state. So I just want to focus, because those two programs are so important to South Dakota, I want to kind of look at how this money has been allocated across the U.S. and kind of where South Dakota stacks up against some other states. So the total CRP benefits, the kind of concentration with the most benefits received are South Dakota, Minnesota, Iowa, and Illinois, so kind of in this region, but also quite a bit of funding going to the South and to other states in the Corn Belt and Midwest. And West, I mean. And then we can also look at total CRP benefits in dollars as a percentage of nationwide CRP funding. But also we can think about the total number of acres covered as well and the number of farms. So South Dakota ranks 4th in CRP benefits. Iowa is well above every other state in the total number of CRP benefits they receive. Dollar-wise, Iowa is receiving 21.7% of the nationwide funding for CRP. And we could see South Dakota ranks 4th, receiving about 6% of the total funding from the 2018 to 2022 Farm Bill, covering about 147,000 contracts on 68,000 farms, over 6 million acres enrolled. So we can see the size and importance of this program in this state. We can also think about CSP funding by state. So kind of those states that are most important for CSP funding are South Dakota, Nebraska, North Dakota, Minnesota, Arkansas, and Mississippi. And if we look at the total CSP benefits received on the last Farm Bill, we can see South Dakota had the highest dollar amount of CSP benefits received at 8.6% of the total Farm Bill funding nationwide. So by showing you this, I want to point out just how important these programs are for the state of South Dakota and for the U.S. as a whole, particularly when thinking about conservation funding. There's been a lot of focus on climate smart agriculture, climate smart commodities, a lot of investment by the government. So we can see what an important role South Dakota has in those policies. Now I want to talk a little bit about spending outside Farm Bill because in recent years this has increased in importance. I don't know if things will continue this way. I think it could depend on the outcome of the next presidential election. But I want to talk a little bit about the additional spending we've been seeing outside of the Farm Bill for agricultural programs. So we had the Inflation Reduction Act, which passed in 2022, formerly titled the Build Back Better Plan. But within that act, there was specific allocated money for agriculture, a total of $40 billion. So 20 billion of this is supposed to go specifically to Farm Bill conservation programs. 14 billion of this is supposed to go to rural development, and 4 billion is supposed to go to mitigate drought impacts in the West. So when we're worried about the Farm Bill expiring and some of these programs running out, we don't have to worry about commodity programs specifically because this funding allocated by the additional funding allocated by the Inflation Reduction Act for these programs. Another area where we saw large federal spending outside of the Farm Bill was the Climate Smart Commodities Program. So this was a grant program that funded $3.1 billion for 141 projects. This was funded through Climate Commodity Corporation funding. And I want to point this out because I really think this shows evidence of kind of the direction and the amount of spending that's been going towards climate smart agriculture and what this could mean if the Farm Bill. Some people have debated pushing out the Farm Bill a couple of years to get through the next presidential election. I don't know if that will be the case. There's just been some of the discussion within government, but I want to show this as evidence of this administration has had a particular focus on agriculture and as part of a solution to climate change. So in 2021, one of the fighting the climate executive order on fighting the climate crisis at home and abroad, President Biden specifically mentioned agriculture as has a role in fighting the climate crisis. So has specifically been targeted as part of this administration and part of the policy since the beginning. And these programs and the spending is kind of evidence of that. I'm not making any judgment statements whether that spending is good, whether that spending is bad. I'm just saying this is evidence of this overall plan of reducing U.S. greenhouse gas emissions. So depending on the outcome of the next election, I think that could determine whether some of this spending outside the Farm Bill continues or not. But the Climate Smart Commodities Program, what it does is provide technical assistance to farmers who are thinking about adopting some of these climate smart practices, and also help us quantify some of the greenhouse gas benefits because the science still needs a little bit of catching up, and we still need some in-field verification of how much these practices are actually sequestering. And it also helps develop markets for climate smart commodities. So right now, there are some maybe very niche opportunities for farmers to receive additional payments for their commodities, which were raised in a more climate-friendly way. But there's no widespread overall kind of climate smart commodities program. So one of the goals of this funding is to develop markets for these climate-based commodities. And as part of this grant in South Dakota, they had a total of 23 projects receive grants. These cover 38 commodities and 95 practices. So I know South Dakota State is involved with one of these projects, a big project involving livestock grazing. So I just want to mention this as kind of part of the discussion of thinking about spending outside the Farm Bill and the direction that those funds have been going. So I want to kind of wrap up and leave some time for questions and discussions. So the most recent Farm Bill is expired and something's going to need to happen by the end of the year, or some of these programs that don't have appropriations could run into trouble, like the dairy programs or some of the commodity programs. So there either needs to be a Farm Bill passed or some sort of stopgap passed by the end of the year. First, we have to overcome that hurdle of getting the new House Speaker in. So as I mentioned, the programs funded through appropriations like SNAP and crop insurance will continue no matter what. So you don't have to worry about that too much yet. But some of these voluntary programs, if we don't get those funded, they revert back to laws written in the 1940s, which is not something we want. There's been some talk that it could pass by the end of the year, but we'll see what actually happens in reality. There's a lot of hurdles to overcome before this actually happens. And I hope that kind of the data I showed you stresses the importance of conservation and climate funding, particularly for the state, and helps us think about priorities going forward in the Farm Bill, especially when we look at spending outside of the Farm Bill and in what areas that spending has been in. I think it's definitely gives us a clue about future direction for spending. And continue watching the news headlines carefully. I know I will be. I think my AgriPulse headlines have a new policy update every day. And we'll see what happens with this Farm Bill discussion. Now I'd be happy to take any questions.
I did submit a question to you there, Sarah, regarding some of your slides at the very beginning. If you wanted to answer that question right now. So for those of you that are on the phone and don't see the chat, the question states, on the first couple of slides, how are you projecting the spending budget between the components of the Farm Bill and the conservation programs? It's going all the way out to 2033, but isn't that subject to how they decide future farm bills?
Yeah, exactly. That's a great question. And that's why these are just projections. So to be able to discuss the funding, the Congressional Budget Office has to publish these projections, but ultimately they are just projections. They'll be subject to discussion. And of course, if we look historically at what's happened, there's always been a lot of infighting between the different programs within the Farm Bill. So we have to have these projections as a place to start, but will that be where we end up? Probably not. Hope that answers the question.
I don't see any response in the chat. So any other questions while you're thinking of them? Otherwise, feel free to put them into the chat, and I think we'll move to our next presenter, and we can always have more discussion at the end of our session. So thank you very much, Sarah. Very enlightening and informational.
Thank you.
So next up, I think I've been in extension now for 22 years, and I'm still the new Ed Gray. So we're going to invite the new Joe Santos to our to the session this morning as we move forward here. So with that, Triwit, I'm going to have you share your slides and turn your camera on if you would, unmute. And so he is our new macro econ specialist on campus. So I will let you introduce yourself a little bit more there. And again, if there's questions, type them into the chat and we will get them taken care of. Or if you need to unmute and ask a question at that moment, we'll try to get them handled there too. So with that, I will turn it over.
Thank you, Heather. Thank you for your kind introduction and your kind invitation for me to participate in this event. Thank you, Heather. Thank you, Matt, and thank you, Sarah, as well. And Jack Davis and everyone who's involved. I'm Triwit, Ariyathugun. I'm originally from Thailand. I joined the Ness school a few months ago as an assistant professor of economics, teaching macroeconomics. And so without further ado, let us go into the topic for today would be, are we heading for a recession or not? And I think this is an important question for us to know for in terms of what we do, how do we prepare if the recession is coming? So into that evaluation, I am going to focus on the current state of the U.S. economy, summarizing the current state of the inflation, of the interest rate, the labor market, and we will use that to finally analyze whether the recession is coming. And let's do it. So inflation is a percentage growth in consumer price index. So if the price level grow fast, we have an inflation. The announcement that just came out in October 12th. So last week, the consumer price index level in September for our urban consumers increased by 0.4% seasonally adjusted. So that's month-on-month price level growth, and at year-on-year. So from current September compared to last year September, we're at 3.7% inflation. And these are quite high levels. As you know, the Federal Reserve have a mandate of achieving price stability at 2% average inflation. So we are quite a bit above at the moment, and the month-on-month reading 0.4% kind of surprised the market by quite a bit. The expectation was only 0.3%, so this is a 33% deviation from their expectation, which kind of spooks the market, because these statistics will go into the Federal Reserve decision to raise interest rates further. Core inflation, excluding food and energy prices, we have that it is up by 0.3% month on month, or 4.1% year on year. Long-term horizon inflation, though, is down to marginally to 2.8%. It's down for gas, medical care, rent, college education, but it's up for food. For the Midwest region, the solid purple line is a growth in consumer price index year on year, and we are at about 3.3%. So that's below the national level of inflation. Luckily, the dash blue line is the core inflation. So it's the growth rate in CPI, excluding food and energy. We are at the around national level, so 4.2%. In terms of the components of the price level growth, we have shelters up 0.6% for the month, 7.2% from a year ago. Energy up for 1.5% for the month. Food up 3.7% from a year ago. Services is up. Vehicles is mixed though, so new vehicle prices are up, but used vehicle prices are going down. Labor wage increases were softer than expected, so 0.2% for the month, 4.2% from a year ago. And so that may be actually a good sign, because the labor wage growth is particularly what the Fed pays close attention to in terms of how they decide on the interest rate policy. In terms of the interest rate path, as we are all aware, we are currently in a quite a high interest rate environment. The rate hike cycle started in March 2022. Rate went up 11 times, from near 0% to currently 5.25 to 5.5% as the range for the federal funds rate target. And the federal funds rate is the rate that banks charge on overnight interbank lending, which then pass on to credit and to consumers. And it's projected to be up by another 25 basis points before the year ends. The September Fed funds rate projection went up. So a few weeks ago, we have a recent FOMC meeting where the committee decided to maintain the federal funds rate at the same range, 5.25 to 5.5%. However, the long-term projection of the interest rate, meaning the rate on the longer-term bond, has gone up quite a bit. The projection is up to 5.6%, 5.1%, 3.9% in 2023, 4 and 5. And these numbers were up from 5.6%, 4.6%, and 3.4% in these years. And these were the projections that was made in back in July, but these are the current September projections. So the market takes that as a sign that the long-term interest rate will be higher than expected, which will hurt several sectors in the economy in terms of increasing the cost of capital, the cost of credit, particularly for those businesses that are sensitive to the interest rate, such as tech sectors. We have a steeper yield curve. We have 10-year U.S. Treasury yield is at kind of decade high. So we are at 4.7 to close to 5% right now. This is the highest level since 2007. Rising interest rate implies, I think implies stronger US dollar value. The currency of the US dollar is very strong compared to the rest of the world, because the US is kind of almost always the leader in terms of raising the interest rate. And when interest rate is high, investors will chase after high yield by moving their money into the US, increasing the demand for the US dollar, increase the value of the US dollar. US dollar end up being stronger than other currencies in the world. Is also explained by strong US labor market as well. So if the US economy is good relative to the rest of the world, US dollar tend to be strong. And it imposed, however, tough conditions on the exports, because US goods will become relatively more expensive compared to the goods from other countries. And so we have tough conditions for exporters. And it may also hurt businesses that are sensitive to the currency, meaning that if they have debt obligations to pay in US dollar, but they get revenue in their local currencies, that may hurt their business quite a bit. And so the currency have major impacts on businesses. In terms of the labor market, the left chart shows the unemployment rate. Current unemployment rate is at about 3.8%, reflecting fairly strong and robust the state of the job market. The right chart is present the non-farm payroll employment over the month change. And the most recent reading in September. So these are the announcement, non-farm payroll announcement is made every month in the first week of the month. And in the current month, at the beginning of October, the report for the September non-farm payroll indicate a much stronger than expected non-farm payroll employment, almost double the expectation. If we look at the chart, the rightmost bar read at about more than 300,000 job added to the economy, whereas the expectation was only something like 175,000 jobs added over the month. And so this almost double the expectation, indicating a strong labor market. Overall, as we study the state of the inflation, labor market, and the interest rate, are we heading for a recession, which may be a big question that we are all wondering. And if we look at the one good recession forecaster, at least for the past 11 recessions in the US history over the past 80 years, can be told by the spread between 10-year and 3-month US Treasury bond yield. Basically, subtract the 10-year yield, the yield on the 10-year bond minus the yield on the 3-month bond. What that difference is, and then if that difference is, it should be positive, because investors should command high yield if they want to lock their money with the Fed for as long as 10 years, they should get some sort of premium. So the 10-year yield should be more than 3-month yield. But it is usually the case, except when the economy is kind of heading to a recession where investors end up wanting their money fast. So the demand for liquidity drives the 3 months above the 10-year. And so if 10-year 3-month is low or is negative, it's not quite a good sign for the economy. And currently, as we can see from the chart, the rightmost current reading is that we have at least negative 1% 10-year 3-month spread. And so the recession should be coming. And actually the the recession was expected to come since this year, 2023, but somehow we have a delay in recession. So the probability of recession was projected to be 75% in the middle of the year, but now down to 68% probability of recession over the coming year, which is still remain quite high. So to summarize, inflation rates have remained higher than long-term Federal Reserve long-term goal, have cooled down though from the pandemic, strong labor market, rising interest rates, steeper yield curve, strong US dollar hurting exporters, and commodities or goods that are tied to that are sensitive to the currency. Credit conditions remain sound, though we look at the corporate bond market, which is the largest for the US, is the largest funding source, more so than bank loan. It's a non-bank loan or corporate bond, which is quite dominant in the US market. It still remains kind of sound. The spread between corporate bond, Moody's season BA corporate bond yield relative to the 10-year US Treasury also remain at the level that where it should be at about 2%. And so I read that as a indicator that the credit conditions in the US remain okay. And the data from the Kansas City Fed also says that in terms of the agriculture, the land value remain robust, which means it can be used as collateral for borrowing and lending, or for the credit for the farms. However, the aggregate amount of lending has been decreasing because of the effects of the higher interest rates at the moment. And then overall, we see that recession is likely to come, but will be delayed until 2024. However, there's potential several major risks coming up ahead. Oil price remain elevated, international conflicts, wars, government shutdown, possibility of government shutdown or fiscal stances, the debt ceiling discussion was in debate over the past few months. But all in all, it can be a mild recession if the credit condition remains sound and labor market is okay. Mild recession is possible, but it also depends on the Federal Reserve future path of interest rate as well. And so I'll stop here, and thank you again for having me in the talk, and happy to answer questions.
Thank you for joining us. We greatly appreciate your willingness to step into this new position. Maybe you didn't know Ag Economic Dialogues were going to be part of your title when you joined SDSU Extension.